Yes, we are.
Susan, are you going to control the share screen on the booklet, or do you want Charles to do it on our side?
Yeah, no, I'll do that here now that I believe we're live.
Well, there's one more from Dr. McNamara, and she was wondering about the special ed service that is very good to ensure that the technical knowledge of their
We can put more trash.
our special ed teacher.
We did that in college.
We did when we first moved over. When we first moved up here, we had to do that. Some more.
Hey, Sue.
Louis, how are you?
I'm good. And you?
Good. You want to start, or what do you want to wait, or you want to?
Do we, I would say that we go ahead and start. Let's see, we
Okay.
have Sheila, there's 4 of us here, yes.
Okay.
Ready for us? We can start.
So welcome you ready for me to call roll call, Sue?
Yeah, I am.
So welcome everyone to today's meeting. Thank you for taking the time to join us today. We are going to have a full agenda today. So Sue, can you take a roll call for our attendance today, please?
Yes. Angela Banks. Here. Christina Bennett.
Present.
Joseph Clark. Darnetta Klingscale. Lewis Cross.
Present.
Sheila Goodson.
Present?
Donna Jones. Yvette Levy. Bobby Richardson.
Present.
Albert Sanders.
Here.
And Justin Stein. So not yet. So we have 1, 2, 3, 4, 5. We have 6. So we have enough for a quorum.
Okay.
Thank you, everyone. If everyone can please put their phones on mute. I'm going to hand it over to Dennis McCaskill with Exponents so that we can start our educational program for today.
Thank you, Christina. To the chairman, Mr. Cross, members of the Board of Trustees, your executive director, Susan Kane, your consultant, Kristen Finney-Cook, and to all participants on this call, thank you for this opportunity to come before and meet with you today. We're pleased to work with you currently with the active global strategy, global equities, as well as with the U.S. fixed income strategy, yield advantage differentiated income. I'm Vice President, Business Development and Marketing, and with me today is Charles Curry, Managing Director, Senior Portfolio Manager of U.S. Fixed Income, and Randy Lestick, Director, Portfolio Manager of U.S. Fixed Income. If we may turn to the table of content, please. Today, we'd like to review the firm background briefly, and that you've heard that in the presentation that was provided by our founder during the presentation. Secondly, we'd like to review the bond tutorial, and of course, we have an appendix there. If we may turn to section 1, page 4, please. We have a brief overview of Exponents. As you know, the name Exponents was derived from the word exponent, meaning a zealous champion for our clients, as well as to be a higher level of engagement with a broader array of solutions to meet our client investment needs. The firm is women-owned with a diverse investment managers founded by our founder, Tina Biles Williams, in 1996. We have an entrepreneurial culture. We have the investment or financial strength to reinvest in the business. We have a very risk-aware philosophy. We feel very pleased to have our alignments with our clients through the ownership of our professionals through an ESOP. And we have a duty to serve and improve our community. Today, we're pleased to have assets under management at $12.5 billion. And you can see on the wheel there, active global equities at $5.4 billion, systematic global equities at 4.6. And what we're here to talk with you today from our bond portfolio, the platform, is $2.4 billion. And below here is just sort of a breakdown with respect to that. We may turn to the next page, please. At this time, I will turn this over to Charles Curry, who, as I mentioned before, is the managing director and the architect of this platform for Exponents. Charles.
All right, thank you. Thanks, Dennis, and good evening, everybody. I'm certainly glad to be here with a chance to talk with you. I wish I was in St. Louis. I was kind of reminded of the fact that the last time I went out to visit a client was actually about a year ago today, the last trip I've taken. So who knew that it would last this long? I think you can just go ahead and turn to page 6. I think Dennis already talked about the team, and you have in front of you myself and Randy Lestick. We're teammates. And I guess the only thing I'll say about this page, it's interesting that we're both wearing neckties, because I can't remember the last time I had on a necktie, but that's a whole different discussion. So if you want to continue to the next page, we'll just sort of jump right in. That's the rest of our team. We've got a team of 5 in total. We've got a couple of young analysts that do a lot of our quantitative work. And then we have another senior portfolio manager that works with me on some of the other strategies that we have. Let's just get into it on page 7, if you don't mind, Susan. So I think what we're at, I'm sorry, page 8. What we were asked is we understood was to effectively sort of give you sort of a primer, if you will, on bonds and why do you invest in them in your particular portfolio. And as we think about it, I'm sure that you all have a pretty broad and diverse portfolio. You've probably got stocks, you've got real estate, you do have bonds. But if you think about it, why do you have bonds? And if you think about it, basically bonds are very liquid. You get sort of a fixed rate of return in terms of a coupon. If you hold it to maturity, you earn just that. So you pretty much know what you're going to get. You get coupons twice a year, and then at the end of the maturity, you get paid back. So it's essentially, when you think about what is a bond, it's basically an IOU. And quite frankly, people don't realize that if you look at the extent of the broad bond market, it's probably a lot bigger than the equity market, because there's everything from corporate bonds, such as we show here, General Motors. I mean, you have municipal bonds. I'm sure that in your particular county, you probably issue bonds to fund development of different things, whether it be airports or water, sewage, things of that nature. But again, all of these are people that issue bonds, issuers, effectively just to get proceeds to do projects and new facilities. In fact, we were on the phone just yesterday. We have a client in Philadelphia. It's the city of Philadelphia. And we actually manage for their aviation division or part of the city, the project that they have. They did a bond issue where they raised a lot of money. And as they pay that out as they go along, we manage the bonds against that so that they can have money to pay it off each year. So eventually it will go away, but until they finish that project, we'll continue to manage and earn the interest that we can on it until that goes away. So that just sort of gives you an example of how municipalities use bonds for projects and things of that nature. If you go to the next page, page 9, I have in front of you here, I have what something that we're going to go back and forth to, and I might ask you guys to participate and give us a hand with, we're going to make a decision on something as we go along, so I'll hold that for a minute. This is Home Depot. And what we have here is a picture of what's basically a Bloomberg, which is sort of the information superhighway for all things investments, all things bonds. When we transact with the street, if you will, or broker dealers, we typically will refer to a page such as this in order to determine what the price is before we buy or sell it. So what I want to highlight here, this, if you look across the top line, I know it's looks a little small there, but it's a Home Depot bond, and basically it has a coupon of 1 3/8%, and it matures 3/15/31. So basically, it's a 10-year bond, and you know that every year you're going to get interest of about 1 3/8% paid twice a year, and at the end they're going to pay you back that amount of money. So if you buy that bond today when it was issued, it's at par, 1,000 or 100, and then you effectively will know that if over the life of that bond, you're going to get that 1 3/8 and get paid back. So a couple things of note on here, what makes it interesting, and here's where a lot of times as bond investors, we'll start throwing out a lot of jargon and throwing in sort of the nuances, if you will, is that we'll say a couple things about it. If you look at where that thing came to market, it says in there, it says plus 52 over a 10-year treasury. So you're probably wondering, well, what does that mean? Well, if you think about all of the way that bonds work, they're always relative to something else, that being the risk-free rate. Now, the risk-free rate is the treasury market. And every day you probably hear on the news, you hear, well, what are rates doing? Rates are going up or rates are coming down based on what the Federal Reserve is doing. And rates are how we set everything, whether the auto loans that we take out or our mortgage rates are. It's all based on the cost of money, which is what rates are. And the way that the government funds itself is by issuing treasury bonds, bills, which are very short term, in order to fund the ongoing movement of the government. Now, the thing about a treasury versus Home Depot, what makes this interesting is that a treasury is considered risk-free. There is no risk, although you could argue about that given some of the goings on in Washington in January, but we won't go there. But if you think about this risk-free rate of a treasury bond, today, I think, as a matter of fact, the 10-year treasury was yielding about, I don't know, 125, 1.25, 1.25% for holding a treasury bond for 10 years. So when we look at a Home Depot bond, the idea is how much more should we be compensated by buying a corporation and all the risks associated with that corporation, because that's called credit risk, or a basket of risks that we look at to take into account versus owning no risk at all and owning a treasury. And so every day we go through this decision by looking at everything imaginable in corporate land, whether it be other types of securities that are bundled, that are backed by automotive receivables, credit card receivables, mortgage-backed loans. And the idea is you can buy something at no risk, or you can take some type of risk, that risk being some form of credit risk, or other types of risk include things such as callability risk or prepayment risk. And I'll get into that a little bit later. So a couple things of note on here, and I'll show you these on the next page, is that you see on the right, you see bond ratings, you see A2, AAA. So when you think about credit ratings, again, there's rating agencies, Standard & Poor's, Moody's, and they're paid to rate corporate issuance, whether it be, as we said, Home Depot, whether it be Amazon, whether it be General Motors, anybody like that. And they're rated based on how good their credit quality is. It's almost a rear view look in the mirror at a bond's financials. Do they have the ability to pay it back? Is their business sustainable? Will they be able to issue going forward? And is it a good business, and does it fit well in where the economy is at this particular point in the cycle? So if you think about it, Home Depot, it's probably a pretty good business, if you will. It's got a very high rating because they're making money. They've got a good margin. And if you think about the past year, given the pandemic and everything, what's one thing you hear about? People are doing so much do-it-yourself improvements. People are working on their homes because there's a shortage of houses out there if you did want to move. So there's a lot more of that going. So Home Depot is making a lot of money and doing very well. So they have a very good credit rating. So as a result, when I think about, do I want to buy Home Depot versus that 10-year treasury with no risk? I mean, I can get about 50 basis points, which is 0.5% more than investing in that treasury, but that's not really a lot. So there's other things out there where I can get more yield, because at the end of the day, when you put a portfolio of bonds together, lots of holdings, different bonds, as I mentioned here, you want to put as much yield as possible because we're trying to beat an index, which Randy will talk about in a moment. So if you go to the next page, You see some of the things that sort of define what a bond is. I mean, we have the price, and we talk about when a new issue comes to market, it comes at par. And then over the life of that bond, it may vacillate here and there, really because of the impact of where overall rates in the market are and the perspective of what are the risk premiums. Is it more risky now versus where it was before? But at the end of the day, as I always say, if you buy a bond today and you hold a maturity, that's what you're going to get. But along the way, it's going to have different valuations based on people's opinion on the riskiness of the bond or what's going on in the economy or what the government or treasury is doing. So you see a couple of things. We talked about the coupon. You have a couple of, you typically will get paid twice a year, that interest rate that we see there. And you have a maturity date. At that point, it goes away. That's the difference between bonds and stocks. With stocks, when you buy a stock today, 5 years from now, you don't know where it could be. It could be up 20%, it could be down 10%. It's all about participating in the growth of the company. When we buy bonds, we do so with the idea that, you know, all we want to know is that we're going to get paid back and we're going to get compensated for the risk and loaning that money to them. So that's primarily sort of the difference, if you will, in doing both. And I mentioned security and their collateral. Sometimes you buy bonds that are backed by something. We have owned taxable municipals that are backed by new toll roads or something. So the toll revenue is coming up, pays back the bonds, but it helps fund the development of that. Or you can buy securities that are backed by, let's say, you know, Ford's auto receivables. They've made a bunch of loans or finance department. And it's collateralized by the loans that they've made to invest to people like ourselves who bought cars. So that's what we talk about, collateral or security behind that. So if you think about the different characteristics, and I touched on a little bit about, you know, less risk to more risk, typically with bonds, the shorter the time to maturity, the less risk there is, because frankly, you know, unless a bond goes into default, and that's very, very rare. I mean, you have to look back a long way. Ones that you remember years and years ago, something like Enron or WorldCom, that's well over 15 years ago. I mean, that's you know, the idea of what makes a bond not pay what it's supposed to. And so by virtue of being very short and having so little risk, your yield is going to be less. Okay, those are less risky. I mean, you could typically, or in some cases, you can have a higher credit rating. That's also less risk just in general. And then on the flip side of that, if you want to take on risk, you typically will buy things out longer to maturity, because if you think about it, the longer you wait to get paid back, the more things that can happen along the way to throw off the perception of that bond, or maybe the viability of the company or security you're investing in. And then you can also do lower credit rating. We happen to specialize in looking at things with lower credit rating because we do a lot of work from a macro perspective to understand how a company works in a particular environment, how it works versus its peers, and then whether or not it makes sense to invest and get compensated for that. And so as you look across the bottom, it gives you an idea of sort of a continuum. As I mentioned on the left, you've got the government, which is treasuries, and I was using a 10-year treasury, which today is yielding about, I don't know, 1.29%. And then you go from there to go to like something like an agency, which is everything from a Fannie Mae, which is a little bit more than a treasury bond, but still very high quality, not as much spread. Then you go to an investment grade bond, much like we were talking about a moment ago when we were talking about Home Depot. And then you go to something called high yield bond, which some people will call junk, because those are what's called non-investment grade bonds. And those are bonds that have had, you know, serious, you know, they have too much leverage. They've had serious issues with the ongoing viability of their business. And so you get compensated a lot for that. And those have a different profile. They still have the idea of being able to buy them at a certain price, but you tend to get enhanced yield because you're taking on more risk. And it goes all the way to the stress bond. Yes?
Can I ask you to explain to the board, given our investment policies that we have duration questions, so we have duration in our fixed income, what that means for the portfolio that you manage. And I think our duration is I believe, Dennis, 7 years. And so can you explain that in the context of how you invest and some of the parameters that you see from various clients that put those restrictions for fixed income and how it applies to our portfolio?
Sure. What I'll do is I'll talk about duration, the concept of what it is, and then Randy's going to touch on the index and the actual bit on the portfolio itself. So I'll have him pick it up as we go along. But I mean, again, I'm sorry, I couldn't see who that was speaking, but what she was referring to, and I mentioned this, is how the price can move with a bond over a longer period of time, and that's due to duration, which basically says that given a move in interest rates, what does the price of a bond do? And if rates go up, prices fall and yields get higher. And as you go along the way, to sort of give you a simple example, and I'll go back to that Home Depot, that's a 10-year bond. So basically that 1 3/8 bond for 10 years, if rates all of a sudden were to rise by 100 basis points, the price of that bond would fall by about 9%. And so that's due to the fact that it's a longer horizon, and you're getting paid cash flows all along the way. And that's essentially how duration works. It's a measure of interest rate sensitivity. So what Christina's speaking of in your portfolio, you all have boundaries in the overall portfolio as to how much duration risk you can take on. So in other words, if you were to buy, I'm going to give it, you could never have a portfolio of all 30-year bonds, because that would be inherently very risky, because there's a chance of tremendous price volatility in that. And so what you do by effectively putting a border around your duration call is you're trying to minimize the price volatility, because you're very concerned about preservation of capital and minimizing that, because most of your risk is taken in other asset classes. And so, that kind of gives you some perspective on sort of how that works. If you go to the next page, and I'll talk a little about it again in the context of duration. Now, this is an Apple bond, 2 Apple bonds. In green, you have an Apple bond that is about, I think it's 5 years, and the other bond is about 30 years. And so this just shows you last year how one's price was all over the place versus the fairly steady price of the shorter bond. And it goes to what I was speaking about earlier in duration, that the longer the bond is, the more duration it has, because you're waiting a longer period of time to get your cash flows. But that being said, if you look at this chart, particularly the 30-year bond, you see that tremendous drop right in March, the end of February. I don't know if anybody wants to hazard a guess as to what happened in February, early March of last year. Well,
That's funny.
Yeah, and so in so many words, and Christina, I know you're probably thinking about now, is that was the outbreak of the pandemic. And at that point in time, before the Fed and the government all stepped in with stimulus, rate cuts, we all had this premonition or idea, the markets that is, that everything was going to shut down and the financial system was broken. And quite frankly, if you think about it, again, to go back to what I was speaking of, risk premiums and how you take risks in portfolio, at that moment, there was such fear in the market that the whole economy had shut itself down, and that there was no demand for anything, because we were all in the house and we were all social distancing. Everything just sort of fell out of bed, if you will, all at once. So this is Apple. So Apple, very high quality. And I think just probably everybody on this call has something in the Apple ecosystem. So at that point in time in March, the long bond of Apple, which is a 30-year bond, which, by the way, gives you a coupon of 2.95, and it matures in 2049, which is right at about 30 years. That bond went from being well over par when everything was sort of normal risk premium, Apple, who doesn't have an Apple, to in March, when we thought the world was going to end, that bond dropped to 85 cents on the dollar. So then the reason it did is that, again, the risk premium, because of the market's perception of what was going to happen to the economy or lack thereof, made everybody think, oh my God, Apple's going to go out of business. It doesn't make any sense at all, but that's the whole idea of risk and knowing when to take risk and when not to. Now, from a bond perspective, when we think about the economy, when we looked at what was happening, we were looking to buy securities that had widened out like that, because for the life of me, I did not think the world was going to end at the beginning of the pandemic. And we also knew that the government was going to step in with guns blazing in order to fix this situation, which we saw them do by addressing with all the stimulus and helping corporations sort of get back on their feet or make it through. So you see how bonds can drop in price and one day then go back up in price the next day. But at the end of the day, if you bought Apple at the beginning of the year and you held it to maturity, you were still going to get the basic yield you got. And then all along the way, that movement in price is what's called mark-to-market volatility. It's just the fact that we have to keep score every month as to what is that bond today if they try to issue at the prevailing market rate. And it goes up and it goes down depending on rates are, depending on how the economy is. When the economy is really strong, rates start to back up a bit because we're worried about inflation. When the economy is very weak, we lower rates because we're trying to encourage people to spend. We're trying to encourage corporations to keep people employed, and we're trying to encourage them to borrow to keep the economy going. Because one of the things that people realize is that if you think about GDP and our economy, it's basically 2/3 of it is driven by us, the consumer. So if we're not spending, that's a major drag on the economy, and everything comes down, whether it be bonds, will probably be seen at higher yields because people will be worried about that, and stocks will fall fairly dramatically, which we know that has not happened. So if you think about, again, thinking about what your portfolio is and what we're doing for you is we've put together a portfolio where we've made decisions every day about whether we own an Apple or whether we own a Home Depot or whether we own a mortgage back. But the idea is how much yield can we get in this portfolio? How much income can we get so that over time we can beat the benchmark that you put us up against? And as Christina alluded to, you put risk parameters around that so that we have sort of a universe of what we can invest in and what we can't. And it also gives us some guardrails about how much risk we can take. Because obviously, if you wanted to just say, okay, I want to get as much yield as I can, I would just buy the longest bond and I would just load it up and take as much risk as possible. But that's not prudent because we're but one manager and a cadre of managers you have, and you've got an overall portfolio. So we play within a certain boundary that you've sort of set up, again, in concert with the strategy that we have. And the goal is to put appropriate yield in there, take the appropriate risk, to buy the appropriate bonds and put together a portfolio that can beat the index. And so unless there's some other questions, I'll let Randy sort of talk a bit, really kind of extend along some of the questions that Christina brought up.
Okay. Okay. Good afternoon, everybody. I guess it's still afternoon there. I guess the next page. Okay, this is the index. We always refer to it. So one of the measurements that we use is talking about the aggregate index. And the reason we use that aggregate index is because it's all the bonds that are investment grade. It doesn't do high yield and it doesn't do municipals, and the index doesn't take in some of the other specialty type issues. That index, though, I mean, you're all familiar with the indexes on the equity side. There's the Dow, which has 30 stocks. There's the S&P 500, which has 500 stocks. There's the Russell 1000, which obviously has 1,000. The problem we're talking about here, the index that they use, which is everything that is rated investment grade, and now because of the size of the market, they keep limiting the number of issues that they have in the index. So when they first started this index, the aggregate, it was every issue that was above $25 million in size. 3 years ago, they raised that number from $250 million to $300 million, simply because they wanted to get less than 10,000 issues. Now, the trouble is that we keep issuing debt all the time. So today, 3 years later, it's $300 million to be included in the index for a single issue. And there's now 12,000 names in the index as it just keeps getting expanded. But there are a lot of different names, but that's the index that we run against. Next page. I think for the time value right now, I'm going to go on to the next page. And by the way, anybody has any questions, please feel free to ask me anything that you need. Sometimes we get a little bit jargony. I've been at this for 4 decades, so it just becomes second nature. So we're looking at your particular fund because you're in our differentiated income fund. So what is that? What we're looking for here is to enhance your income. Again, as we talk about a bond, it's the coupon that's important. And we also try and look for some capital appreciation. And the way we do that is I particularly buy bonds that are below par. So at least I know in the back of my mind, when we get to the maturity, I get an extra few percentage points of kicker that's coming in there because they're going to mature at par. So one thing you know about a bond versus a stock, I know where the ending value is going to be. I just, it's somewhere out in the future, but it's going to be par. And if I pay 90 cents on the dollar, I'm going to get the full $1 when it comes to maturity. What we do is to try and be different from everybody else is that, as I said, most people look at the market and say, well, it's an index security. We're looking because 80% of the bond market is managed as roughly about 10 firms. And what happens is, I'll be very honest, they're so large now when we talk about the PIMCOs and Northern Trust and BlackRock, et cetera, that just for size, they don't want to buy an issue than some of the large insurance companies. You know, if they can't buy $50 million or $100 million at a time, they just don't want to buy it. Well, the advantage becomes now is there's still a lot of securities out there in the world that are a lot smaller than that, and they just ignore it. So what we do here is we look for still investment grade credits, but we're looking for smaller deals that people basically don't keep track of. And because of that, yeah, you give up a little bit of liquidity, but you get back a lot more, yield. And that's what we're looking for. At the end of the day, you want to get a return on your money. And so that's what we're trying to do in the portfolio. So we take the idea that we will give up some of the liquidity. In other words, we're not going to get we're not going to buy, as Charles showed you there, that Home Depot issue, by the way, was $1.25 billion in size. I probably work in sizes that are like $50 million or less. So it makes a big difference sometimes. We give up some liquidity, but we can get a lot more return. Now, what I don't do is we don't go to non-investment grade, as he talked about it. We don't go to junk that some people do to get extra yield. What we try and do is we don't go outside the United States. We basically stay, dollar terms. We don't go into the emerging markets. And we don't take large interest rate bets, which I'll show you at the end. Next page. So what we do in the portfolio is an example, as Charles pointed out, there's agencies. So right now, the biggest portion of the index is the US Treasury. So the US Treasury issues debt, but at the same time, there are other parts of the government-owned situations, such as Federal Home Loan Bank, still reports to Congress, still backed by the US government, but they issue debt and give you an extra 30, 40, what I used to use as a benchmark is give me another 85 basis points more than the Treasury. Same risk. You're still looking at Congress. It's the same people that have the printing presses, but why not get a little bit better return? So what we do is, instead of doing straight treasuries, I'll go into agencies that have a little bit of a structure and basically pick up more interest rates. Today, you can look at a 10-year treasury at 125, but I can buy a 10-year agency at maybe 165. So you pick up some extra yield. Again, it's on credit. We use some specialty type situations here. Boy, it's going to be a lot of jargon. But we're basically looking at smaller issue sizes. We'll do credit with a lot of issues that are 10, 12, 15 million. But it doesn't matter. Even on the agency size, we'll do $25 million agencies, but it's just as liquid as a treasury, because you still have over 6,000 banks and 1,900 insurance companies. There's always a bid for that government paper. So you're really not giving up anything there. And then the other side, we talk about securitized. Probably what you'd like to know, securitized. The best market that you probably know is the mortgage market, where you buy your house, you put down your down payment, somebody puts it all together, and we take a look at it. Well, we use some of the securitized areas, such as CMBS. You're looking at basically loan to value prices, if you put it like a mortgage, at less than 65 cents on the dollar. So there's plenty of room inside there, and what you do is you bundle it. Now, the reason these aren't in the indexes, most of the asset backs and CMBSs and CLOs, they come to market and they might be an issue of anywhere from $400 million to $1 billion, but they cut it into different slices. And as soon as they make it into 4 or 5 slices, they're less than $300 million, and therefore they're not in the index. It's still a liquid deal. It's still large in size, but it's not in the index. And in many times, you can pick up extra yield this way. And we basically look for that in the secondary market. Next page. I don't want to go to appendix. It should be, let's go to the next one. It should be just a run of your portfolio. There we go. There's your portfolio characteristics. So here's the things that we want to talk about. Number one, it shows at the top your duration. Yes, the higher the number and the duration, the longer it takes you to get your money back is what it basically means. And the second part of it is it gives you the interest sensitivity. Now, you basically have in your guidelines is you don't want to be above a 7 in the duration. And right now, the index at the end of the year was a 6.26. By the way, because of the Treasury issuing now more money, because they started issuing 20-year bonds this past year, and they do it every month, and it's $27 billion a month. And you have the 30 years and all these other things. That duration is slowly creeping up. So just something for you remember on the committee, that duration is getting higher. Every month it goes up a little, like a 0.07, 0.10, et cetera. So you have that to look at. But our duration is shorter than the index, which is 626. Our average life down there, as you can see, is 7.2 years but the index's average life is 8.14. So we're almost a full year shorter than the index. But again, you can see that since the end of 19 on the right-hand side in the column, we're creeping up too, but we're staying close to that index, but we're staying a little bit shorter. But our yield, because of the differences that we put in there, and that's what you're going to get at the end, as I said, you hold to maturity. Our yield to maturity at the end of the year was 5.34%. And the index, by the way, in December was 1.02% yield to maturity for 8 years. To me, that's almost, I don't care what you care about inflation. If inflation's 1.5%, they're still stealing money from you. I mean, I at least want to get something better as a return. And so how do we do it? Well, you can see down below when you look at the portfolio against the index, we don't have treasuries. But agencies in the index is only 1.7%. I like to try and keep it around 20%. Why not take the same risk and get paid more for it? So let's use agencies. They're all backed by the federal government. We're not taking any more risks than buying a treasury, but we're getting an extra 40, 50 basis points in yield. And you can see over the year, the difference from last December, we're up 1.6% more in agencies, and I'm trying to raise that a little bit higher. You look at the index, so it says mortgage backs and CMBSs. The index is 25, we're 15. But again, we've been raising that. Last year, in hindsight, it was before the pandemic. I'm sorry it didn't work that way, but I was actually taking money out of some of the bank loan area, and I was buying CMBS paper because they said, I feel safer having a security. It's backed by assets behind it. On CMBS, you got warehouses, hotels, industrial parks, office buildings, multifamily apartment buildings, et cetera. And you're buying them where you basically have, not only are you buying them at less than 65 cents on the dollar for the valuation, but you also get some credit enhancement. I don't want to go into that, but there's other things that go along that things would have to fall to less than 50 cents on the dollar across the whole portfolio not to make any money. And we increased some of that. Now we took some of that, what we call it an asset-backed loans, that's ABSs. We took those down. Those are basically bank loans. And we were reducing that because I thought there was a little bit more risk there. And credit, we basically used most of the credit, I would say, on that side where it's 39 versus 32. Almost all the credit in your portfolio was bank paper. And the bank paper that we're talking about are major firms. We're talking Goldman Sachs, Morgan Stanley, Bank of America, Citicorp. I'm trying to think some of the other large banks. And those actually, in a way, there's an extra little, even though it looks like we're taking more risk because it's higher than the index, those issuers all at Goldman Sachs, those issuers are all because of the Dodd-Frank bill in 2008. The government has basically said they are significant financial institutions and they can't go out of business. Those firms that I just mentioned, none of them can basically go bankrupt because the federal government's going to back them. Now, they have special regulations on them. They have special boards that look over them, et cetera. But I think that you get a great return and you actually have a little bit more backing behind it than what the general agencies put in there. And of course, there's cash, which is not in the index because you have to buy something. And actually, right now, the cash position is probably down a little bit, as you can see. Year over year is down 1.3, and that's just the flow that goes through the portfolio. I don't know any other questions you might want at this point in time. I know we've gone past our limit at this point for more than half an hour. But if anybody has any questions or particulars that they want to ask about the portfolio, I'd be glad to answer.
I don't have any questions. Does anybody from the committee have any questions?
I don't have any questions, but I thought that was a great overview. Thank you.
Thank you.
You're welcome.
And I just want to say thanks to our education committee of Darnetta and Sheila, who put a list together for us for the year to be able to just give the committee a little basic understanding of various different asset classes in our portfolio. If not, Sue, can you see if Kristen has joined?
I am here. Thank you.
Oh, yay, yay.
Yep.
Then,
she's here.
if there are no other questions, I'm going to turn it over to Kristen. Thank you for joining us, Kristen. I'm still on my phone, about to transfer over into my computer. But if you want to take it over, Dennis, thank you to the entire Exponents team to give us an educational fixed income overview. It was wonderful. We appreciate it. It'll help us with our knowledge and our decisions as we go forward. But thank you. You're more than welcome to stay on. But Kristen, if there are no other questions, I would like to hand it over to you.
Yeah, so thanks so much.
Thank you, everybody.
Thank you.
Thank you.
Thank you, Dennis.
Guys.
Great
Thank you all so
presentation.
much.
Thanks, man.
Take
Thank you.
care. Sue, are you going to put the presentation up?
Well, which one did you want us to do? Did you want to do the fourth quarter report? You gave me two, the capital market one and the fourth quarter one. You want that one?
Yep. Why don't we go through? Well, you know what? Let me just ask what the pleasure of the board is. Do you want to go through your capital markets? It's a long deck, but I'm going to summarize everything pretty succinctly. And I know you've already heard quite a bit from Exponents, so I don't want to sort of rebound anything, but I will talk a little bit about your asset allocation. And then, you know, we have the longer quarterly deck, which of course, most importantly is going to be the January flash, because obviously fourth quarter has been, that was December 31st. So is there an interest of one over the other, or shall I just choose?
I say go ahead and choose. It's your lucky day.
Okay, so why don't we very quickly, maybe we go to the quarterly report. I'm going to really focus on that fourth quarter, January flash, just to, you know, make sure we do our due diligence and understand where we are in the portfolio. So
All right.
okay, let's see if I can make this a little.
Oh, I'll go bigger.
Thank
Is
you.
that better?
It is. It is. So I wanted you really to focus, as usual, on the longer term performance. And maybe I'll just take a step back. As a reminder, equities have continued to do well over the longer term. Growth has done better than value, albeit we've seen in the last several months where value has really done well. Your portfolio continues to be a very diversified portfolio. You may have seen when you looked at the quarterly that, you know, maybe the performance was not as strong, or you didn't rank as high, maybe I should say, as some of the others. But that really has to do with your asset allocation. I do want to highlight that diversified portfolios that are really geared to mitigating risk, just didn't do as well because the equity markets were so robust. And so you just saw up with the equity markets, which is not sustainable. We don't plan our portfolio on one asset class. We really look to have a well-rounded portfolio. So I just wanted to caveat my comments around that, even though we are going to focus mainly on the January performance. Now, when we look at the January performance for your 1 year, you had 12.5% return, which is outstanding return. And as you look down, you see that you have a lot of strong positive numbers. As I mentioned, just to highlight the difference between large cap value and large cap growth in particular, which is going to be halfway down the page, as well as towards the bottom, I'm looking at the green shaded highlighted pages. And if you look at your 1 year, your value number was negative 3.4%. Lomax, Edgar Lomax, did struggle a bit, but I have to mention that they've done very well up until this last year, being a value manager with a growth type of market environment. And so we don't think there's anything wrong. So I just want to say that up front. But if you can look, you see that your value was negative 3.1, and then look down just a few lines down and you see your large cap growth at 31.3%. That is a 36% difference. Wow. amazing. As they Ripley's Believe It or Not. And so I just want to focus on that for a minute because that is really important to note. I would also mention that the benchmarks have been very difficult to beat. And so while Intech was at 31.9% and TCW was at 30.6%, they trailed their index. And so we, again, do not think there's anything wrong with these managers, but active management didn't pay off because the index was really in the top decile almost. And if you remember, the index is usually in the 50th percentile. So again, these managers made some great performance for you at 30% return, but they did trail the index. We understand why they trail the index. As a reminder, the index, of course, is going to have any and everything. It's just a basket. They're not thinking about risk. They're just putting everything that falls into that stylistic box into into it. However, the manager, of course, is going to be having risk metrics and really be looking at putting the portfolio together in a manner that takes into consideration risk. And so it's going to be much more thoughtful around that. And so with that in mind, we want to make sure that we're thinking about that, understanding that, so you know why your managers did the way they did. Your core, which did exactly what we would expect it to do, somewhere in the middle at 17.3, so not 30%, but not negative 3%, as you can see, but that's very much expected because, as a reminder, the core is going to be a blend. Now, I'm focusing a bit more on your 1 year number because that's when you have enough data points to understand what's going on with the market. Obviously, the 1 month, you can see that you were down about 50 basis points. And that, your large cap equity your large cap equity was down. But in particular, I'd like to highlight the fact that large cap value, while small, was up 0.2%. So again, that's when we started to see the pendulum swing a little bit differently. And Edgar Lomax really just matched the benchmark. So that gives you the story on your domestic equity portfolio. When we go through the capital markets assumptions, one of the things that we are suggesting, and you have it in your portfolio, is still holding tight to the equity. The U.S. equity right now is poised to continue to do well, given what we have seen globally. And so that would be more of a tactical bet. And so just in your perspective or in your portfolio, just a bit of a bias. We wouldn't be looking to really change. I don't know that we'd be looking to change the policy, but we'll talk about that shortly. Sue, maybe you can turn to the next page, please. Okay, I'm sorry, I was on mute. My apologies. So now
I thought it was me. I was like, did I lose connection?
It was me. So sorry. So small mid cap. Okay. You see, again, more strong performance, 23.2%. Again, the Russell 2000 at 30.2%. So that once again shows you that these benchmarks, these indices were doing very, very well. So at this point, I do want to look at Westfield, which had 36.1, and then Systematic Financial Management at 13.1. That's going to be your value. Again, we see that difference. If you scroll, though, to that 1 month time period, you see Westfield was down 1% and Systematic was up 2.9. So that just gives you, again, the same story, the same theme that we're seeing. DFA is a microcap portfolio, did very well at 19.1 for the year and then 5.1. So I think, again, the moral of the story is while we might be trailing the benchmark a little bit, we're adding some real strong returns during these periods. And so I think that we want to make sure we don't lose sight of that. International did well, but not as well.
Kristen, can I back you up a bit on small to mid cap? Mm-hmm. One thing that the reason that we pick managers within a certain asset class like Westfield and DFA, basically Systematic and DFA, is that while they may be in the same asset class, they have different styles of selecting their portfolio, and whether they're quantitative or not, or they're, a little bit more focused on the benchmark or not. So while we may have 3 different managers with 3 different styles, that's why we pick managers. And when we select managers, we look at the correlation between what managers we existingly have in their portfolio and how can we differentiate one manager from another for the same purpose of focusing on asset allocation within a subcategory of our portfolio. And so, yes, we don't want, if we picked managers all with the same style, we would have all the same return and really add to our risk factor. So again, we've done a great job in a very mature portfolio, selecting managers that complement each other on their styles. And that's why we have a difference of managers, and some of the, the benchmarks could be a little bit different, but I just wanted to point that out, that that's why we select multiple managers in a asset class to help us, whether it's an up market or a down market, but to be able to offset each other on some areas. And so if you wanted to elaborate on that, Kristen, you can.
I thought you did a wonderful job, Christine. Peter, yeah, I don't know that I have much to add. I mean, I thought.
Well, I gave you a break too. I gave you that drink break there for a second, so.
So international, as mentioned, did well also, but didn't do as well as domestic equity. But you can see both Fidelity and Causeway added to portfolio. Causeway is going to be more of your value manager, and Fidelity is a bit more growthy. So again, same playing out on the international side. When we did look down to emerging market equity, EME also struggled to keep up with the index. The index was up 27. Your portfolio was up 21. DFA was up 11.7, and then Invesco did well, shot the lights out at 24.5. So strong performance all around, quite frankly, which is what's contributing to that 12% return that you did for the 1-year time horizon, which is well above your actuarial return. Would you like to move forward, Sue? Thank you. Your total global equity, again, following suit, it's all country world, or MSCI world, which incorporates everything, the whole world. And so that's going to be a mixture of US as well as non-US. And that is at 12.7%. And so you have under there the underlying managers. And I should remind you, though, while you did get 12.7, a part of that, a decent amount of that was from Progress. So it wasn't just Exponents, but Exponents made some changes, and you can see the managers that they have in their portfolio at this point. So we can probably move on to fixed income, I think. Yep, thank you. Fixed income did well, 7.3%. That's much higher than what we expect. At this point, core fixed income 5.2. You can see Manulife, Earnest, and the Exponents all did relatively well. Your absolute return fixed income did great at 10.5%. Lumicel's really a bit more strategic, a bit more aggressive, and so we love the returns there. And then even your tips, which is a great place to have your portfolio as well, at 9.1%. So everything was doing what it was supposed to do. And so that's always a good thing, because when we plan our asset allocation, that's what we're hoping for. Global multi-sector, which also had some EMD, did well, but not as well. EMD didn't do as, just in general, didn't do as well. So you see Neuberger Berman was at 5.6, still, still relatively, diversified. And then you have your dedicated EMD. So Lazard was at 7.7%. So you have overlap in global multi-sector as well as EMD. You kind of not double dipping, but you do have a little bit more than what you're seeing at the 3.4%. You also would have had high yield also in your global multi-sector. We can move on. And And then you have your global GAA, which is your global asset allocation. And again, this is another take the handcuffs off type of strategy. It allows you to go through multiple different asset classes. You know, it has sort of a 60-40 split, as you can see on the benchmarks, and that was able to post about 9.8%. Ultimately, I do think we're going to be looking to probably downsize the number of managers. I know I've said this before, but you you don't need 3 at this point. So we'll be looking to probably narrow that down a bit, even if it's, you know, even if we keep a 5% allocation, having 3 is probably a little overkill at this point. And then we have your hedge funds. Your hedge funds did 7.3 for the year. They were trailing and down for the month. So that's a very short time period. So it's hard to really determine where that is. Grosvenor did well for the year. It seems like they reversed a little bit. We'd have to dig in a little bit more. I'm sure some of the tactical hedge funds didn't do well as well, in particular, as well as long short did struggle. And so Grosvenor is going to have a very diversified basket. You can move forward. I'm sorry. And then you have your real estate. We usually look mostly at your private real estate through the IRR, but you can see that UBS Trumbull funds have done okay. These are funds that over time, as we look to diversify out of them and move more into non-core private real estate. So we are already addressing this component of your portfolio, as well as we'll be looking at private equity, private debt. So we have a number of things that are coming on the pipeline. So I think this is it. Are there any questions? Okay. If not, then I'd like to turn to the capital markets. I know it's been a long meeting, so I'm gonna, and I can feel that I'm the only thing between y'all and dinner. So I'm going to speed it along, but you have a great sort of, you know, guide, if you will, to kind of review and look at and just sort of absorb the information in nice bite sizes without trying to go through it all at the same time. But maybe if we get started, Sue, and let me see, I don't have a book. Yeah, let's, you know, why don't we keep going here? This is a whole lot that there. Let's just keep going. Right there. Thank you. I just want to give you a high level what our thoughts are. So we're talking about permanent interventions. What is permanent interventions? And there's a whole sort of chapter, I'm gonna call it, or tab on this in the book. But just to give you perspective, this is when the Fed and central banks tamper, that's not a positive word, but basically inject their will money into the system, helping to keep interest rates down and the like. As you know, interest rates are at an all-time low. There's actually some concern that they're going to go lower. And there's also some concern that the monies that were stockpiled for COVID are going to be put back into the central bank, which could cause an issue and push things down lower, even lower, which then maybe they have to start to increase interest rates, which could cause some concern as it relates to whether or not monetary and stimulus policy is going to continue to be productive and be accommodative. And so that's something that we're managing. But given what we went through over the last year, we should have probably, if nobody was, if the central banks were not sort of interjecting and intervening, we probably would have been in a full-on recession. So that's not the case. So it's good to kind of know where we are, but this is something that we think is going to be a permanent function. So we no longer think that this is going to be a situation where we just, the markets just kind of go where they're going to go. We think that there's going to constantly be some sort of intervention that takes place. Because of that, we also are thinking that considering higher strategic allocations to your equity, which I've already talked about, makes sense. we think that this long-term long-term theme is something that's going to play out over the next several years. And so that's something when we look at your asset allocation, we could talk about. Adequate portfolio liquidity, you all always have that. We're always looking at that, and we also are always stressing it. And then just managing and thinking through that there are a lot of different ways that the portfolio can go, which is why we want to have a very diversified portfolio, which you already do, because we don't know that while we might say that we have a little bit higher strategic allocation to equity, we don't know when that theme is going to go away. And so we want to always be mindful of that because we've had such a shock to the system. And while we have a vaccine, there's still a lot we don't know about the vaccine. And so it's proceed with caution, if you will. And then, maintaining your strategic allocation to treasuries, as you saw, did very well in your portfolio. So these are things that you actually already have in your portfolio. So I would say this is a reaffirmation of some of the decisions that you've already made, which is great because we're already able to take advantage of those and we don't actually have to move into them. So that's always good versus going into an RFP and it being the summer or the fall before we are able to get in. So maybe I'll have you move forward. So again, I just talked about these themes, and here a little more crystallized, the virus trajectory, that's really going to be about how the market recovers given the virus. I've talked a bit about the permanent interventions, globalization, backlash. That's really all about middle class shrinking, the wealth gap increasing, and there being concerns around whether that's happening because we are becoming global. So the concern that countries become more insular, which is happening a bit and being forced a bit because of the virus right now. So, each country for themselves, right? Don't cross borders, don't come in here, don't go there. Everybody's sort of looking to take care of themselves, which we understand, but it has global and economic implications. And then China transitions. We still think, and I talked a lot about this last year, that China is still growing at a rapid rate despite COVID. It is going to probably be about 18% of GDP in about 25 years. And so that's real. But we also know that it's a bit on the back burner as we focus more on the virus trajectory and permanent interventions. And so with that in mind, maybe we can flip forward a couple of slides. Let's see. Oh, no, I'm sorry. Go break right here. This was actually one. And I probably should have been talking about this, but just to give you, I just went through this, but this is a nice little sort of scorecard. So this shows you what we think in the economy is really dominant versus neutral or dormant means that it's not really playing much of a faction. So I just talked about permanent interventions and virus trajectory. And so globalization is still relevant. And then China transition, which is, in the trade policies and the like, and the trade agreements, those we're still looking as impactful, but more on a neutral basis. They're not upfront the way they were last year when we were talking a lot about late cycle, if you remember. And so there was this wonder of whether we were going to have the different bubbles, which I think the slide is in here as well. So I wanted to just highlight that. And again, I'm happy to delve in any of this that you would like, but I know it's been a long meeting, so I just want to make sure that you know kind of how we're thinking about this framework and where the information is. So maybe we can move forward. And so I'm going to, these sections, Sue, because this is now just going deeper into what I've already explained, we can probably move past. So there's going to be 4 sections that, talk about this. Like I said, nice reading, bedtime reading. So the globalization one, and then we'll come up with the China one, and we can then move past all that, unless you have questions. Take one step back there. This is what I meant about the bubble chart, if you all remember this from last year in those separate tiers. So again, just reminding you where that information is in case you just want to get up to speed on it. Maybe go, so you can kind of move forward. So yes, yay, here we are. So these are our core geometric return assumptions. So this is for our 10-year and 30-year. And if you look here, you'll see, when you think about U.S. large equities at 5.4%, for 10-year and 30%, excuse me, 6.3 for 30-year. That just gives you an idea of what we think over the next 10 or 30 years that equity is going to yield. So while it's yielding 30%, 25% right now, we have to be mindful that at some point there is going to be a shift. And so the portfolio, as we look at it, we build it for the future and for the long term. And so that's why we don't just put everything in or pull out and the like. So this just gives you an idea of where we are and what are the higher called ranking asset classes, if you will. Things like private equity, which you're doing and you're a little bit underweight on that. So we'll be trying to shore that up a bit. That's an area that you can see definitely strong returns, albeit it has a longer duration. And so we have to keep that in mind from a risk standpoint. Also, when you scroll down to real estate, core real estate is about 4.4%. For the 10-year. I would like to mention though, that we've been actually shifting your portfolio to more non-core. So the managers like Elm Tree or Big Basis, if you will, those are all non-core real estate managers. And so those managers, our expectation is going to be higher than that 4%. And so I just want to note that, because you may look and say 4%, that's not that great, but we're actually looking at it from a more diversified perspective.
So Kristen, let me interject here. My camera's a little close. Wanted to touch base on this 10-year return. So in 2021, we're going to do our 5-year experience, I believe, Sue, later this year sometime.
Yep.
And so when we look at that 5-year experience study and we work with our actuary, then we come back to this 10-year return. I want to bring it all together to be able to talk about where our projected return is on the portfolio based on the experience study and the actuary numbers. And then really what we currently have, which is from our last study, we have it at, is it Sue, is it 7.25?
I mean, our expected return is 7.5.
Or 7.5, okay. So we used to have it at 10 years ago or whatever. We dropped it to by 50 basis points. And then, given these numbers and what that experience study will come, and we haven't been blowing it out of the park to be able to probably over 5 years to stay in that range. Is this something that we should be looking at when we go through that process with our actuaries, so that we know, or is this something that you update after we do our experience study?
No, so these are updated numbers. So we've already updated what our 10-year and 30-year numbers are. I think that it's important to take these into consideration as you are looking at what you've done over the last time period. But again, you see the numbers that I'm showing as an example for equity, large cap equity, and they're not, double digit. Whilst when you look at some of your portfolio managers in the equity range, as an example, they may be double digits. So you have to just be thoughtful around, and they'll explain this to you, I hope, that, we're looking at it on a forecasted basis. And sometimes if you're talking about a certain return over a 10-year period of time, you may get the bulk of that return in 2 to 3 years, which means the other 7 may not be as high. I mean, again, we won't know until we go through that 10-year period. And, sometimes you're not exactly right, but, this is what we're seeing. And as a reminder, we do a building block approach. So we're looking at the bond yields. That's where we're starting. And then we're building on top of that, what are the equity premium? What is the illiquidity premium? And all of that comes into play. We're looking at dividend yields. So we're looking at price to earning ratio. So there's a lot that we're putting into that building block approach to come up with these numbers. They're not just kind of brought out, I guess it's formulaic, but most importantly, it's building blocks. So you can actually see how we kind of get to those numbers and what component of them are, just, the bond yield component or the dividend yield or the price to earning, and the or PE ratios. That's another way of saying that. And so, that's all important, because it can almost, you got to just be careful that, you do these experience studies, but if you have had a really strong run, they may actually bump you up. And there may not be the basis to do that if you think about where we're seeing markets on a go-forward basis. So I would just say utilize all the information together as you look to come to a decision on where you should be. Hopefully that answered your question, Christina. Okay, great.
Yeah,
So
and
maybe we
the
can,
experience study just will be presented either at the October or no later than the December meeting this year.
okay. So maybe we can move to the next page. Okay, so this is just showing you all the asset classes that you have in your portfolio, so you can really see that you aren't overly overweight in anything. You've got a lot of pieces to the pie, which is good. It's exactly what we said. And you can see what your actual is versus your 2020 policy. And so your expected return is a little down. You know, your standard deviation though is also down, and your Sharpe ratio is just the same. So Sharpe ratio is really measuring your utilization and whether you're getting the most return for the amount of risk that you're taking. So you are taking a little bit less risk, and you're getting just a tad bit less return. So that's okay. And we've talked a little bit about moving your portfolio up on the risk return base spectrum just a little bit. So maybe we can move to the next page. Okay, and this is just going to show you what your actual asset allocations are. So you see where you're underweight, which is in the red. So your non-US portfolio is in the red. And one of the things that I like stuck out to me like a sore red sore thumb was your private equity. You're down almost 4% on private equity. So that's an area we probably want to start to shore up. We won't do it all in one year because we want vintage year diversification, but that's what's hurting you a little bit on those returns because private equity does tend to generate strong returns over public markets typically.
Kristen, I'm going to stop there and ask, I know Angie, is this what you were looking for, Angie, when we talked about asset allocation in our mixes? I know that was a question you had in the last couple of meetings.
Yeah, this is exactly what I was asking about.
Okay, so Kristen, so if we look at, so this is our policy that we did, and this is our actual. And then if we look at, I guess, is this what Sue utilizes to get back into compliance when she's looking to rebalance?
It is, but we have a range. So, we don't want to make knee-jerk reactions, of course. Right. So we do have a range around each of those targets. So if we get outside of the range, then Sue is looking to start to rebalance closer to target.
So is that like, let's say, for example, large cap equity, we're at 15.4 in our range, or our target is 13%. And is that 2020 policy, is that like going forward that we want to work with going forward? So Sue would look to rebalance or pull cash or from our large cap equity providers to get into the maybe 14% range. Is that, I just want us to be able to all understand what we put together and how Sue utilizes the direction from us as a board in our asset allocation. And I think that is what, maybe if I'm wrong, Angie, that's what you were looking for, correct?
Right.
Okay.
So what I would say is, yes, this is your 2020 policy, the one that we worked from last year. And unless we make changes, so if we don't make any changes, this will become your 2021 policy. As it relates to changes, there's not a huge amount that I would be making outside of, right now, when you look at it.
What about GAA? We have talked about that for years to reduce it, even if it's a percent, we instituted GAA well over probably 10, 12 years ago because we didn't have some of the diversification in some of our asset classes. So I think that that is something I didn't know if we did that, where would it go? What would you recommend if we drop that down to 4% or so? Again, that's the GAA, isn't that the
global asset allocation?
Right, but I'm trying to think of the managers that are in that.
PIMCO, Mello, and GMO.
Yeah, okay.
So
Mello or Mellon?
Mellon.
Melon's in there, yeah.
Yeah,
So to answer your question, you're absolutely right. And as a reminder, last year we actually had 10% in GAA. So we've already reduced it.
Okay.
So that's the good news. But to your point, I'm not 100%. I mean, we don't have to have it at all at this point. Your portfolio has gotten far more complex.
Right.
And so when you think about the fixed income areas that you're in, and all GAA is, it's got fixed income, it's got equities, it's got emerging market stuff in it. Sometimes they might have a little gold in it. I mean, it's kind of a hodgepodge of things. It's a go anywhere type of portfolio. That said, you already have a lot in your portfolio, so it's not necessary. We can eliminate it, or we can go down to 2.5%. I mean, I can bring back another asset allocation and show that. As it relates to where it would go, I would probably definitely put a little bit more into your large cap equity, just from what I've sort of shared with you already. Maybe thinking about a little bit in your private debt, because fixed income is going to, credit is, your long only credit isn't doing as well expected. I mean, we've had a stellar year this year, but if you think about where it's going forecasted to be, so your private debt is it's really private credit. That's what it is. And so you could put a little bit more there, especially right now. There's some great opportunities that we're actually going to be bringing forward to y'all in the next couple of months. Like, I won't go into them, but like Cray Hill is one of them that, taking advantage of distressed, direct lending, special situations on the credit side. Those are areas that we see in this market could do really well.
Okay, so I guess my recommendation would be to look at that GAA. And I know that this is something that several trustees, and I know myself, have discussed in the past, is if we have a mature portfolio, to consolidate some of them and not add, every time, we come to it, we add another manager, and our portfolio keeps getting larger and larger when it comes to manager numbers. But, if we look at that GAA and recommend, instead of keeping 3, look at for us, do we consolidate to 1? And does that get us to, and that way, we deploy those assets into another manager while reducing our manager count by 2, for example. So if Angie, if that is something that you're agreeable with, and the rest of the board, if we can look at that going forward and really focus on some of these other asset classes that we have.
Yeah, I completely agree. I think I mentioned actually earlier about we don't need 3 for sure. And so whether we reduce the percentage that you're allocated or not, I would recommend that we still go to, if you keep it at 5, maybe at least down to 2. If you move down to 3, then 1, and if we eliminate, then 0. And then I've kind of shared where I would put the assets, or consider, and I'll bring back, what those expected returns look like.
So do we need a motion for that, or do we just continue to work, because it's going to be a work in process?
Yeah, I mean, it's up to you guys if you're ready to do a motion, because then we would bring it, we could bring it to the board meeting on Monday, and then, that would be it going forward. That would be that change.
That sounds good to me.
Well,
if we did a motion,
Oh.
that would be great. That sounds good to me. How about you, Chris and Angie and Albert and the rest of the trustees?
It sounds great.
Angie, what about you?
So are we talking about a motion to reduce the GAA, or something broader than that?
Well, we would reduce GAA, so we would get a motion to reduce, to have NAPC research the reduction of GAA class, and come up with a recommendation where to deploy those assets.
And Kristen would do the research for that. Is that right?
Absolutely.
Okay.
Well, why do we need a motion for her to do some research? I guess I'm wondering.
Well,
she's going to come back and give recommendations. So if we have to have her go do a research or search,
It may not be a new firm, it may be a new firm, but we want to be able to come to that discussion from committee to take it to the board so that she has her marching orders.
I just felt that it should go on record as that we did explore it and we asked for research and then for a better positioning. And that's why I said we should do it in a motion, Angie. What are your thoughts on that?
That's fine, as long as I'm not making the motion.
And this is the motion, is it gonna be to go from 3 to 1 or just to do the research?
Well, we will allow NEPC to make that recommendation for us, because right now, none of us have that ability. I mean, I don't know, I wouldn't know what to recommend to
I wouldn't either.
eliminate, you know, their research department would look at our 3 managers and make that recommendation for us, and then go back and do. So I guess instead of historically what we've done is we're not talking about managers that are not producing here, right? We always look at the situation of replacing somebody who's not doing well. Well, these managers have done fine for us, but if we're reducing that asset class down to a lower amount, then I can't recommend any one of those 3 to be able to be cut out unless we have the research behind it, because they're going to come back and say we can keep 1, you know, and X, and we'll get rid of maybe, you know, I don't know what the recommendation is going to be. And then here's what we recommend for you to either a new manager or spread it out amongst these various different managers that you already have. I don't know what that recommendation would look like. So this is kind of different for us because we're not looking at a situation where we want to get rid of a manager for cause, right? We're looking at reallocating and waiting on them to give us the recommendation of where to reallocate those assets and reduce an asset class that we've had for a very long time.
Sue, what are your feelings on it?
Yeah, I think, you know, we just have to be, I guess, clear on what we want, you know, NEPC to do. So we have to express that in the motion, whether that's to, you know, research, or if we want to say we're going to reduce to 1 manager. I think, you know, that, you know, as Christina said earlier, that would give NEPC their marching orders then.
Right, and anything we do is going to be, you know, if we do a motion today, it goes to the board and they say, the full board says okay, but then Kristen has to still come back to us in an investment meeting.
Exactly.
The recommendation, and then we would say yes or no, and then we would still have to take it back to the board, to the full board, to be able to accept the recommendation from the committee, whether to reduce, hire, whatnot.
Okay, Kristen, is that okay for you?
Yep. So I'll just come back with a scenario or 2 that takes into consideration reduction or elimination.
Okay, so who's Christine? I'm glad you have the words for that motion.
So I move that, I make a motion that we allow NEPC to research our options for reduction in the GAA allocation and come up with recommendations to the board hopefully at our next investment meeting.
I second Richardson.
Okay.
Any discussion? Sue, do we need a roll call or can we, yeah, roll call, please?
Yeah, I'll do the roll. Angela Banks,
Yes.
Christina Bennett,
Yes.
Lewis Cross,
Yes,
Sheila Goodwin,
I think she's away from the,
She have hers on mute.
is she on
She's
mute?
on mute.
Sheila, thumbs up or thumbs down? No, she's still trying.
okay.
Say yes or no with your thumb.
Sheila, you're on mute.
Can you unmute her?
Yeah, I just,
Okay,
Yes.
Sheila. Yes, okay.
okay. Yvette Levy,
Yes.
Bobby Richardson,
Yes. Yes.
Albert Sanders,
Yes.
and Justin Stein.
Yes.
Okay, so that's 8. So the motion carried.
Thank you for that, Sue. Kristen, I will turn it back over to you.
This was the bulk of my discussion. So if there's no other questions,
Are we
this
gonna,
was,
did we, are we gonna go over the minority manager?
I'm sorry.
Or did we do the, what am I trying to think of, the watch list?
Oh, that you said the watch list?
Yes,
Oh, that's in the other report. It's in the other report. That was in the quarterly.
I did not review that beforehand. Was there anything that we needed to adjust there? But I just wanted, if we can pull it up just to let people know how to read it, because some trustees have not seen it. And I just want to go over that really quick so that we can explain it.
Is it, Kristen, before or after the flash?
Probably before the flash.
Okay.
There it is. Yep, that's it there.
Yeah,
Seems like it has some verbiage in it.
It does.
Let's see. So
It
that's
shouldn't be
beginning
that
of it.
far. Hold on.
See, that's the beginning.
Let me
Yes.
see. I'll go through it on my. Oh no, this is I have on the wrong document. Should be after the performance. Total fund to risk. Oh, maybe it's after. Maybe it's after.
Okay, so I go.
Let's keep going.
Oh,
Oh,
there it
there we
is.
go. There we go. I thought it would have been before. Sorry, because it's
Okay.
there we go. So, yeah, so we just, if there's been any sort of replacement or change, like Lomax had a portfolio manager replacement, it's someone that, you have all of these that tell you what it is. And then on the right-hand side, it says due diligence committee recommendation. So the areas that there's concern or that we think you should watch, like Loomis or PIMCO. PIMCO's in that's your GAA manager. May make it a little easy for us, but those are areas that we should watch. That doesn't necessarily mean a termination. And so the next page, actually, if you keep going, now here is going to give you all the details, all the names, who's leaving, who's staying, and what our thoughts are on it. So like if we go Lomax, Murray is staying, he's familiar with the portfolios, been with the firm for 15 years, and this was more expected. So we're not concerned, as an example. So that's how you read it. Was there anything in particular, Christina? But that's really just the format.
No. And so this is the verbiage. Did we have the math calculation?
The math?
Yeah, we used to have a report that had the managers and they would show the quarters by compliance based on our.
Yeah. No, we don't have that. We haven't, that's very labor intensive. I think that we stopped doing that actually with Kristen Jackson. It's been a while.
Well, and the reason I asked that because that shows our trustees how we calculate what requires for performance when we put a manager on watch list.
Yeah, that's what I was looking for. I remember some time ago when we'd see those different colors, and if there were 3 in red, we'd put them on watch or whatever.
Okay, I'll have to try to see if I can find that format.
Yeah, that shows and I guess we could do a training session on that or education on how we read our investment guidelines, how we track our managers, because this is more of a quantitative. This doesn't show us like our guidelines that tell us as trustees when we put a manager on performance on the calculation of how many quarters or what that means. And I thought I saw it up when we did the color coding up top, Sue, when you went through it, but I don't know what that was because I can't see it on my phone because I don't have my readers.
Yeah, that was just, well, so if you go back, that's going to be your, go back to the performance summary, which is before the flash and before it's, yeah, oh, there, whoa, whoa,
The color
whoa.
coding. Oop, oop.
Yep. Keep going. Keep going to the performance summary. Keep going. Okay, here you go. So now this is going to give you whether you're top quartile, which is going to be green, between 25 and 50 yellow, and then third quartile, and then fourth quartile. And so not having that private equity really hurt y'all quite a bit.
And Kristen, I will find an old report because I think that while the quantitative summary is fine, the numbers is what really shows our trustees. Sorry. My dog is going ballistic. She never comes in here. So I'm going to find that report because I think that that would be a really good way to educate our trustees on how to look at our managers on performance and how to make the decision when we put them on watch list versus, and then when do we ask them to come in based on that quarter rolling compliance that we should be tracking. So I'll find an old report, but I think that's, Angie, that's something that we had talked about in the past. And for those that have been here a little bit, Louis and Angie, you probably know what that report looks like, Sheila, to be able to help us understand a little bit better what our guidelines say and how we track it on a fiduciary basis.
Okay.
Yep, that's exactly what I was looking for. And it was by manager, not just kind of.
Yes, it was by manager.
And we had talked about doing that training on the watch list next month in March.
Sounds good.
So I don't know if Kristen,
we're going to have to get an analyst to go back.
Yeah, if you'll have time to put that together or not, but we had discussed doing that.
I'm sorry, doing the
training on the watch list, kind of going through that watch list report.
Yeah, that was on our training schedule for March.
It was?
You don't see it?
Did y'all tell me that?
We did, because you said you would have it for the December numbers, because we asked for it for third quarter and you said we'll get it done by fourth quarter. And so then we put it on the training for March so that we would have December numbers to be able to look at that compliance.
But that's for the brokerage.
No, not brokerage, watch list and brokerage.
Oh, I thought it was brokerage.
Yeah.
I thought we were talking, I'm sorry. So you want the watch list. Okay, so you, just so I'm clear, you want the watch list, the color coded thing that we had done before.
Right.
And the brokerage policy is in here, right? I think that's in there. Should be. Can you, it'll probably be by the due diligence.
Oh, back.
Yeah, it is in here. You know,
I think you passed it up.
Yeah, I think.
Oh, it's before.
Mm-hmm.
Sorry.
There we go. So there's the brokerage report.
Right, which we are totally in compliance. You look at the right side and everybody's over 10, 5 or 10%. So.
Yep. So this is what I thought we were talking about. And then for the manager compliance, what we provided was what we've have, I guess, more recently been providing. So now we're going to need to try to go back and figure out how to.
Yeah. You have the numbers on a quarterly basis. It's just looking at our compliance and color coding it on quarters.
For the managers.
For the managers.
Yep. Okay.
Yep. So that's something that we said we would do at the end of 12/31 of every year was the MBE WBE report as well as the compliance. But the compliance is on a quarterly basis, rolling quarters, not year end.
Okay, I need to try to just find the chart.
Yeah, I'll look, I'm gonna go upstairs later today, and believe me, I've got emails going back to 2005. So I know we did it, we stopped doing it probably like 16 or maybe 17, 18. But
It's
I
been
know-
some time.
but
Yeah,
I
it's been a
know
while.
that, that we can find it.
Yeah, and I'll look too, Christina, to see, I think I have some old reports. I'll see if I can find it as well.
Okay. If I find it, Sue, I'll send it to you.
Okay, sounds good.
Yeah, and I'll just add that I found it very helpful because for most of us working, full time and aren't into this on a regular basis, just being able to see those color codes and track them. So, I mean, it's something that's physical that you can see and then ask questions when you see that performance that appears to be lagging for kind of an ongoing period. So I know, Kristen, that you do comment on why, you still think they're okay, but, just having that physical book with those things highlighted, I think is very helpful for kind of like the lay person.
Well, and as well as it really, this is something that we used to require from our managers to send a letter that said they were in compliance with our investment guidelines and our rules. Well, I don't know if you get those, Kristen, but if we say our managers have to be positive or whatever the criteria is within our investment guidelines for 8 rolling quarters, and then I don't know if they even track that anymore, our managers, if they're looking at that and making sure that they're in compliance, because they should be telling us when they are not in compliance. So you shouldn't have to do, they should be able to send us on a quarterly basis whether they're in compliance with our guidelines based on that rolling quarter performance metrics.
And there are just a few managers that actually do that. That every quarter I'll get something saying we're in compliance. There's just a few of them that actually follow through on that.
Yeah, and if you can let Kristen know who those are, that would be great.
Let's see, is that something that is what we might be looking for going forward, that all of them do that, Sue?
It's basically in our agreements that they are to comply and at least give us on an annual basis.
But do we want to send them correspondence to tell them that we want them to be in compliance with that?
It would be great if they do it. Sue, I can show you, or you can read where our guidelines stipulate that. But again,
could we ask each of the trustees their feelings on it? Is anybody that's opposed to them towing the line and doing exactly what we have them, what we already have in place?
I think this is my thought on it, and I don't know much about it, and I guess I'm looking at Kristen, probably asking her the question. Is that something, or even Sue, is that something that managers usually do?
Well, Al, it's not a matter of what they do. It's what we already have in place for them to do in order to manage our money, I think. That's what I think. I'm right.
I understand that. I do understand that, but I guess my question is, outside of let's say outside of our portfolio, is that something that managers usually do? Does that make sense?
Yeah,
are we asking them to do something? Are we asking them to do something that's
right
above and beyond what they normally do?
Go ahead.
So, like, for example, if you're looking at this page, right, MBE, WBE, right? So our managers are only going to do what we tell them to do.
That's exactly right.
Everybody gets relaxed in performance reporting, right? They've been we have a very mature portfolio, and some of them have been 20-something years in our portfolios, right? So when we instituted this MBE, WBE policy, it was hard to get some of these managers to comply with our reporting because it wasn't a top of mind. But if you operate in the state of Illinois, in the state of New York, and the state of Texas, this is a mandatory requirement that you will get kicked out of a portfolio if you don't do this, right? So those, managers get laxed, and I guarantee you that those reporting requirements come in every single quarter in those states that it's in their state statute to be able to be forced to do this, right? Kristen's in Illinois. She knows that these managers do not play with the rules and the guidelines. We've been laxed and we haven't. And Andrew, right, wrong, or indifferent, it's a surprise to me that we get those, because we never even knew that we do get some managers that do comply with it. So if some of our managers are sending it, others are not, it's because we haven't required them to send it to us, or we used to, and then they stopped and we didn't ask them to continue. So I think it's imperative that they do, even on an annual basis, based on our guidelines. And so that they're not surprised when we call them in for a watch list, right? Because we've had some, we had Buford Dixon that was on a watch list, and they came in and we brought them in because they were on a watch list. And if you recall, Kristen, they came in and said, we had one great month. We want you to give us more money. And we're like, no, wrong perception. We asked you to come in here to justify why we should keep you, right? And so they were pretty surprised that they were on a watch list for us. And we were asking them to come in for performance, not because we were thinking of giving them more money.
It was a long time ago.
Yeah, that was a long time ago. What, 10 years ago, maybe?
Just about.
I'm almost like, wow, that was a name from the past. Blast from
So
the
that was
past.
actually one of your early ones, wasn't it, Kristen? Well, you weren't even here for MLD, same situation that we did with them. So I would prefer that we get them so that Sue can report. Again, this is part of what we didn't have before, was an executive director report that provided us with this information, right? So if we have, 24 managers and only 10 sent in reports, then I would really want something to Sue to tell us that, right? That we've received this reporting, these managers are all in compliance or vindicated they're in compliance. We should be able to have some type of report from Sue on that perspective, and allow us to be informed as trustees.
So our expectation is that they all do it then.
I would say so, if it's in our documents.
So yeah, I mean, what they already signed or what they already agreed upon, it, they would report it. We've been laid back and said whatever.
Yes.
But now we're gonna get back on their heads.
Yes.
Lack of a better term.
I wanted to ask the question. We already know that it's in place. Would it be fair to send a correspondence out to each one of them and let them know that this is a requirement? Because maybe they don't know. Evidently, there's something going on because very few of them do it, and then get a response back, and that response would say, "I will comply with this," which is in keeping with the rules and regs of the trustee board, and then that way they are on record as agreeing to do it, and then that way that also educates them as to exactly what we expect of them, even though I guess it's somewhere in the paperwork when we signed them on, I guess. So would it be fair to let them know and get a response back whether they're going to comply going forward?
Yes, and I think it pulls this away from this reporting from Kristen, right? And it pulls it into the executive director's roles and responsibilities of getting those letters from the investment managers. So that rapport is built with the executive director, and that letter has nothing to do with, remind me, Sue, if that's just a quantitative letter that says, not a quantitative, a qualitative letter that says we are in compliance.
Yeah, basically, some of them will show, what they're supposed to do and where they are.
Right.
But again, I feel like I need to go and make sure that I'm not getting them from everybody. I mean, I've only seen a few, so I'd like to go through and just make sure. And then, yes, we can, I think I can certainly reach out to them and remind them that this is an expectation that we get this.
And I think in response to that, I think that there should be something where they say, yes, we will comply going forward. If in fact they haven't, and even if they have, that they will continue to comply. I guess something like that. Would that be appropriate?
I guess it would be what is in the agreement. You know, we need
Right.
to look at what's in the agreement and
Exactly.
what does it specify if they don't do that? So
Exactly.
yeah, let me do a little bit of research on
Okay.
this and see who's not doing it, how many we have that are not doing it. And then we can maybe talk about it at next meeting, if that's okay.
Sounds good.
And,
Thanks, Sue.
talk
Thanks, Sue,
about-
because that kind of was my thought. So if they're not doing it, then what?
Yeah.
Yeah. Again,
Well,
we just,
yeah, that's a good
again, we just
question.
have to remind them of what if you look at our investment guidelines, it has it in there. And they were provided our investment guidelines prior to becoming a client. So I don't think it's that hard. Again, it's an analyst that's doing it. It's something that is, they're probably doing it for many clients. It's just that we've just dropped the ball over time and have not required it. And we've never, even as trustees, been informed that those are the letters that are getting. So I think if we tighten our ship a bit and we allow our documents to do part of our job, then we become a little more informed on what our managers are also doing and complying with what we want them to do.
sounds good to me.
All right, this is probably a bad question. No question is a bad question.
No bad question.
No, everything
No
is
bad
on
question.
board there. That's what
The
you're here for.
investment guidelines, do we have a copy of the investment guidelines
They're on the website.
on our website? Okay.
Yeah, I can send it out to all the trustees too, just so you guys
Okay.
have it.
All right.
Albert, you and I are going to go deep into detail with those, you and me.
I know, that's why I'm trying.
You're doing fine, Al. You're doing fine.
Hey, I'm still stuck on basis points.
Well,
Okay. Well, good. Well, that. I don't have any other formal comments, but I think we've made progress and we'll continue.
okay.
Does anyone have any other questions? If not, I would like to get a motion to adjourn.
I'd like to make a motion that we adjourn the meeting.
Second, anyone? Thank you, Bobby. I appreciate it. We will see everyone next month. And Kristen, we can touch base offline on what that looks like. And I appreciate everyone taking the time to stay a little bit later today on the call. I think it was a great meeting. I appreciate Darnetta and Sheila working on that education committee, and we'll touch base. Oh, we'll see each other on Monday.
Yep.
Sounds good.
Sounds good. Take care.
Thank you.
Bye.
Okay.
All right.
Bye-bye.
Bye-bye.
And Louis, I want to give you a quick call.
Okay, Sue, give me a call.
Are we supposed to all in favor? Aye.
Oh,
Oh,
yeah.
yeah, that's
There you
right.
go.
Yeah,
All in
yeah.
favor?
All in favor.
Unanimous.
Unanimous motion. Thank you, Justin. All righty. Take care.
All right. Thank you.
Bye-bye.
Okay.
All right. Good night.
Bye-bye.